Be careful the bond trap, my friends. I'm telling you, it's alluring. It's alluring. It's going to say, look, the bonds are up 19% this year, and they're less risky than stocks. And you're going to say, hey, that sounds pretty good. I could use the bonds with that kind of performance with less risk, especially because stocks are obviously too high for trading. Oh, no. So you're going to go to bonds and you're going to get crunched. So I did a blog post on this morning because I do these live streams. I get a lot of comments and stuff, and I hear all the time about the bonds. I'm just like, oh boy, we've been through this before, and it concerns me because I'm not quite sure people recognize how bonds work. And I'll go to my grave screaming this from the top of the Empire State Building, Shea Scanlon here in Milton, Georgia, explaining how bonds work. Look, and I'm not the biggest fan of bonds. I like tips. I'm a fan of tips, okay. I would take a fixed annuity over a bond any day of the week for the most part, though, because there's no downside risk of fixed annuity other than the insurance company going kaput. So anyway, let's go to my blog post here. As always, go to heritagewealthplanning.com and you click on blog. Well, actually, you don't have to click on blog. If you want to see my most recent post, you just scroll down here. I should get that like it move. That'd be kind of like a GIF where it moves, the water moves. That'd be pretty cool. Anyway, so scroll down here. I'll probably change this out one of these days too. Maybe get off my monkey suit. Should I change my picture? Say thumbs up, I should change it. Thumbs down, just leave it be. Because I still have my monkey suit. I literally haven't worn my monkey suit in a year and a half. I don't know. Anyway, so let's go down. Be careful of the bond trap. All right, so let's click this guy. I just wrote this and I sent it to the email to the folks who subscribe to my website, my email list. And again, if you want to do that, you go back to the Heritage Wealth Planning and you click on connect. And it'll take you down to, oh, there he is. It's where my little monkey butt was. It'll take you to connect, and you just click on the option here. The only thing, if you're going to do other, is tell me what you're going to do, what you want. I mean, just, hey, Josh, you're the worst. Tom Brady's the worst, blah, blah, blah. Or get access to software. But I don't get why people would take the time to say get access to software, and then I email them and say, I didn't want access to it. That's weird to me. But so don't do that. I mean, if you don't want access, you don't have to put that on there. I'm not sure that I've had that happen like 4 times the last 2 days. It's odd. I don't get that. All right, so let's click this on, shall we? Is be careful the bond trap. All right, so I want to show you. This is from Bloomberg this morning. All right, so the coupon is greater than the yield, and the first thing was coupon is greater than the yield. That means the price is higher than par value. If the yield and the coupon are the same, that means the price is par value. All right, if the coupon is less than the yield, that means the price is lower than par value. So if you look at it like this, right here is a coupon, 2.25. We got a price of 104. The yield is 203. So what we know by that is this 104 is what determines everything. Par value in a bond is $1,000, $100, $10,000. Usually they're $1,000 increments, but they price them in $100. I don't know why that is, but anyway. 104 is the current price on a par value bond of a 100. All right, so the coupon was 2.25. This was issued at 2.25 with $100 as the initial issuing price. So everyone who bought this bond at issue know they're going to get 2.25%. So if they had $100 in this bond, they're going to get $2.25 as a coupon, as the interest that they get until the bond matured. And that was a 30-year bond, so they get $2.25 for every $100 of the bond for 30 years. We know that. But now the price is trading above par value. It's trading at 4.91% as a premium. Well, that means the current yield must go down. The current yield must go down because the coupon will always change and will always stay the same. The coupon will never change. But the yield will change depending on what the price is. And this is all that matters now. All that matters is what we're getting for a yield because the coupon is fixed. The initial par value is fixed. So if the price goes up, that means the current yield goes down. It's a little mathematics here. All right, so notice the price is 104.9, but the par value of the bond is 100. They're always going to be like that. Thus, the bond is trading at a premium, almost 5%. And believe it or not, this is incredibly important. So now let's look at this from about the Vanguard VUSTX, the Vanguard Long-Term Treasury Fund. And this is probably going to be at the end of August, I bet, because Yahoo's usually about 30 days behind. And you'll see, as of the end of August, and I'm not sure, I don't know when, but it's as of the end of, it's not real time, but we'll just say maybe it's even at the end of September. I don't know. It was trading at 19.43 was a year-to-date return. So year-to-date return is 19.43%, which is insane for a bond. But you can see the yield right there is 2.44. So 19.43, and that's what I'm hearing all the time. Like, my bonds are doing great. We shall see. So notice the date, year-to-date is 19.43, which is insane because it's a bond fund. A bond fund with a yield less than 3%. You're not supposed to get those huge returns of bond funds. But now look at the duration risk. All right, so we have duration of this is the same fund. 17.41 is the duration. And what that simply means is the average maturity is 24.2 years. So basically the average bond in this, there's thousands of bonds in the portfolio, would mature in 24.2 years. So it's a long bond for sure. The average duration is 17.41. And that just means that for every 1% increase in interest rates, the price of this bond will fall by 17.41%. All right, duration. 1% increase in interest rates, the average price will fall is 17.41%. So quiz, how much will the rates, if the rates increase by 2%, how much will this bond fall? Well, if you have a duration of 17.41, which means for every 1% increase in interest rates, the price drops by 17.41%, we know it would be twice that. So in that case, it would be about 35%. So just FYI. All right, so what's the likelihood of that happening? I don't know. But in 2005 and 6, the Fed raised freaking 17 times. So it had huge increases in the in bond interest rates for sure. And yet, I tell you, the market just you didn't see bonds getting crushed back then. Isn't that interesting, actually? So the bonds did not get crushed, even though they had huge interest rate increases. Interesting, huh? All right, so what does that have to do with anything? Well, we got huge premiums in bonds. All right, the first chart we showed you that the long-term bonds are selling now far over par value. If you want to buy a 30-year government bond, you pay $104.91 for a bond that will mature at 100. Thus, you're guaranteeing yourself a capital loss on that bond. You're going to pay 100, we'll just say 105 for it. You know it's going to mature at 100. Which means you're going to lose 0.15% a year in share price. You'll have a capital loss of 0.15% a year. Why would anyone do that? Well, because you're getting a coupon of 2.25. The coupon on this guy is 2.25. The only reason someone would say, I will voluntarily lose money on the capital is because I'm getting a coupon that will offset the loss, and that's how we get the yield. So basically what we're doing is we're saying, we're losing 0.15% a year in share price, but we're getting 2.25 a year in interest. So you take those two essentially, and that's your current yield, right around 2%. It's literally that simple. How much am I losing in share price each and every year? Subtract that amount by how much I'm getting a coupon, and that's the money I'm going to get on an annual basis on my bond. So in this case, I'm literally getting 2% for a 30-year bond. All right. Take the 2 point, well, he's getting around to it. There's no way that investor will make more or make less than 2% if he holds his bond into maturity. It's mathematically impossible, unless, of course, the bond goes bankrupt. And it's a government bond, so it's not gonna. So there is no way that this bond right here, which has a current yield of 2.03, and it's not quite, we're saying 2% just because it could, on any given day, on any given yield, there's more than just those basic numbers, but those basic numbers actually do the job 95% fine. So at the end of the day, we're going to, 104.91 is the price of the bond. It matures at 100. You divide that. Basically what you're doing is saying, okay, what is going to my loss? I have a present value of 104.91. I have a future value of 100. I have 30 years. What is my interest rate? In that case, I'm losing 0.15% a year on depreciation or capital loss. I'm offsetting that by 2.25. Thus, 2.25 minus 0.15, and I get my current yield. And there's no way I'm getting more, no way I'm getting less. There's just no way if I hold a bond to maturity. All right. All right, so that's the way it works. All right, so basically what we're saying is the bond is issued at 100 with a 2.25 coupon. It will mature at 100 30 years from now. All right, and all the while it'll pay the owner 2.25% each and every year. Government bonds are literally the simplest thing there is in the investment world, for sure. I bought it at 100, it matures at 100. In the initial time, I get 2.25. There's just nothing else that goes with that. But Josh, I'm making over 19% of my Vanguard government bond fund this year, so you're wrong, because you see 19.43%. Well, let's take a look here. And I hear this a lot. It actually stresses me out because that just shows people don't understand how bonds work. The laws of bonds do not go away simply because you have a bond mutual fund. If the individual bond works just like I said, which it does, just because you own a conglomerate of a bunch of different bonds, the mathematics of bonds still remain. You're still going to have $100 mature par value, a certain amount of coupon, and $100 mature value. That's all there is to it. Vanguard happens to own thousands of bonds in its portfolio. Each of those bonds are still dealing with the same rule. Bond A is issued at $100 with a coupon at X percentage. Bond A matures at $100 after paying that coupon each and every year. Nothing else matters. It's literally that simple. Just because Vanguard owns thousands of bonds in the portfolio doesn't allow them to escape the mathematics of how bond works. When I see a bond fund up 19% in a few months' time, like we're seeing now, the only thing I see is a serious drop in the interest rates over that time, which is exactly what happened. But it's temporarily inflating the prices. Rest assured that price will go back down. They're not going to mature the bond at 150. The price will mature at 100. So when you see a big run up like we've seen, a big price run up of 19%, it's a temporary inflating of the price because the interest rates have dropped. You're going to lose that money, that 19%, over the course of you holding this fund. It's inevitable. It's inevitable. There's simply no getting around this. The reason your fund is up so much is because they have some bonds in their portfolio that have much higher coupons than the current 2.25. So for some reason, there are investors who are willing to bid up those current bonds in order to capture a higher coupon. A bond issued in 2015, for instance, with a 4% coupon is going to be trading at a hefty premium over a bond issued today with a 2.25 coupon. So people are not going to pay 104.9 for that. They're going to pay 125 for that. And that's going to be reflected in the year-to-date return on the Vanguard bond fund. But it matters not, because what goes up like that will come back down. As I showed you on this bond right here, that you're going to pay 104.9 for a bond that's going to mature at 100, and you're going to lose that 4.91 cents over the course of 30 years. The same thing is going to happen all these other bonds. Now, you could sell that bond fund, you could sell this fund and take your 19.43% gain, but what are you going to do with it? If you stay in bonds, you're still going to be buying a 30-year treasury. You're going to be paying a huge premium for 30-year treasuries. Oh, you're right back to where you were, and you're still going to get 2%. You could sell the Vanguard bond fund, apparently lock in that 19.43%, but then you're going to turn around and buy the Vanguard bond fund, and you're going to pay 19.43% over par. Pablo, stop! I keep knocking the table. He gets fired up. Come here, buddy. I mean, there's just a way around that. Now, what you could do, you could arbitrage. Say, well, stocks aren't doing that well, or stocks, whatever you want to do. Why don't you take that 19.43% and pay off some debt? That's fine. But you can't take that bond fund and turn around and reinvest it in other bonds. You are right back where you were. You're going to sell the bond fund for 19.43% above what you essentially paid for it, theoretically. Well, if you turn around and buy that same bond fund, you're paying 19.43% above what someone else paid for it. You're paying a premium of 19.43. There's no way around that. The only way you can make money, this kind of money on bonds, is to take the money off the table and do something else with it. You can pay off debt. You can buy something that's way down. It's like, I don't know. But that's it. You're not making this money as if it's a stock. It doesn't work like that. So look at this. This is the gilt, the UK bond. Look at this. So here we got a coupon of 1.75, and it has a yield of 0.95. What do you take from that? So we got a coupon of 1.75 and a yield of 0.95. So it's yielding 80 basis points less than its current coupon. You want to know why? Because the price is 120. It's a 20% premium over par value. All right, so these bonds, notice as a coupon 1.75, but if you were to buy it today, you'd only get a yield of 0.95 because you're paying 20% over par. And that in a nutshell is what you're seeing in the bond mutual funds that of Vanguard, the exact same scenario. You're paying 20% over par value, just like you'd be doing here if you bought that UK bond. There are some there are some bonds that have huge premiums because their coupon is so much higher than market averages. And this right here is a much higher coupon than market averages. So you're going to pay a significant premium to buy that bond. But it doesn't matter because after 30 years, as this bond gets closer and closer to maturity, the price will go down from 120 to 115 to 110 to 105 and ultimately back to 100. The yield will go up from 0.95 to 0.125 to 1.5 and ultimately to 1.75. It's literally how it works. It starts like this. One side goes up, the other side goes down. It gets back and back and back and back. There's just no other way around that. Ultimately, this will mature at $100 with a coupon of 1.75. Current yield of 1.75. So don't get suckered into the bond trap based on short-term performance. It's all fleeting. Bonds provide you just two things: a bit of stability in your portfolio and a yield that can provide you a bit of return net of taxes and inflations. If you think it'll do more than that, you're greatly mistaken. You really are, and you're taking on big risks for that being mistaken too. So anyway, be careful of that. I'll put a link in this, and if, like I said, if you like what you see here, thumbs up. Don't forget to sign up if you haven't yet, and we'll talk to you guys later. Thanks now.